What's going on, traders? Welcome back to another very important video. If you guys clicked on this video, then that's because you're wondering how the banks trade in the foreign exchange market. Now, if you have no idea what I'm talking about, I recommend you go back to earlier videos where we talk about the top 10 traders in the world, who's really controlling these markets, the secret behind Forex, things like that. So that way you understand this video a little bit better. But if you're all caught up and you know exactly how these foreign exchange markets work and who's manipulating them, then this is going to be a very fun and short educational video for you guys. Again, before we start, just a disclaimer, I am not a financial advisor, so I'm not telling you what to do with your money. I'm just making my opinions public on this video. So if you want to listen or implement anything, do your own research. Not telling you what to do with your money, stating that again. And Forex is extremely risky, so proceed with caution if you put your real money into it. And all results are not typical, so don't be typical. All right, now let's get on with the video once we have all that fun stuff out of the way. But I have two pictures I want to show you guys before we actually hop into the charts. As you can see, I have three charts here, all different time frames, all different currency pairs, just to show you guys that this is fractal. It happens on every time frame, on every pair. But before we actually go into the what, we need to know the who and the why. So as we can see here, the foreign exchange market is made up of all of these people. If you are watching this video, 99% you are probably in this bracket. You are an individual or you are a retail trader. Now, you need to realize, one, you're trading against millions of other individuals and retail traders, but you're also trading against your broker or other brokers, commercial banks, institutional investors, hedge funds, central banks, and companies. So you may think that you're hot shit because you have $10,000 in your live account or $100,000, but you got to remember that companies have hundreds of millions. Central banks own 10% or more of the foreign exchange market, which means they're moving close to $1 trillion a day. Institutional investors and commercial banks are about $1 billion. And you are trading against those people. And here's just a little picture of the hierarchy of how that works. So we are not even on here. We are retail traders. We're not even on this pyramid, but these are the people who are controlling these foreign exchange markets. These are the people with the most amount of money. And as we can see, we have the investors and retail traders or whatever, even if you want to put ourselves on here, companies and whatnot. Then you've got commercial banks or brokers and central banks. Central banks like Chase, Deutsche Bank, HS and HSBC, I think. Citibank, things like that, central banks that are controlling these markets. So now we can actually hop into the fun stuff. So what I have here, now that we understand who's actually controlling these markets and how much money is actually being moved, I want you guys to just always keep that in mind throughout this video. But we have CAD CHF on the hourly time frame. We have USD JPY, a fan favorite, on the 15-minute time frame, and we have GBP AUD on the daily. So these are all different currency pairs on all different time frames, but I'm going to show you an example that is universal because these markets are fractal. So let's uncover our all-seeing eye, and what I have here are a couple of examples of how the markets move and why. So let's just remember that central banks, brokers, commercial banks, companies, institutional investors, the way that they make money is by taking money from someone else, right? Not everyone can buy in this market or in investing and make money because that money has to come from somewhere. Money's not just made out of thin air, unless if you do some more research into the Federal Reserve, but that's a different topic. You need to be taking money from someone else and investing. Someone needs to lose in order for someone to win. So what happens is those people that are losing are the retail traders, because you've probably heard of the statistic, over 90% of retail traders end up losing and quitting because they're all trading the same way. That way is the retail way. So here's an example that I have. What we have is we have a market that is trending up. It's pretty obvious that the market from this bottom point has been rising. And finally, we meet an area of resistance, right? The market hits a ceiling and stops, and it kind of just consolidates in this area. And then we have a little bit of a higher push and the market falls. The reason that the market will stop at certain points after rising is because when the market rises so fast, that means there are way more buyers than sellers, which is pretty obvious, and that sends the market up. But when the market stops, that means there are sellers entering this market because they think it's a good area to sell in here. And then again, we have that example right here. And usually when you are selling, you need to put your stop loss somewhere. Your stop loss is at this red line that I have marked. And the money symbol, well, that's just retail stop losses. So what happens is when there are retail sellers in this area and in this area, their stop losses are probably above the highs, which are these red lines and these money symbols. Then what happens is we have institutional money, whether it be a commercial bank, a central bank, or a broker. They pump money up to the buy side in order to hit stop losses of retail traders, so that way you can get all the retail sellers out. After you've hit all their stop losses, market then reverses to where all the retailers thought the market was going. And where do you think central banks are entering their sells? Not here, but right at your stop loss. And then on the flip side, where do you think all the buyers in this market are? Well, they're probably all buying the market at their double bottoms or their support or whatever indicator is telling them to buy in these two areas. And where do you think their stop losses are? Beneath the low and this red area. So we have our stop loss and our money symbol. After we've hit the stop losses of all the sellers, market then has the agenda to hit the buyer stop losses, which then you can kind of see it creates that triple bottom right here. Market looks like it's going in their favor, and within 1 hour, all the retail buyers are out of the market. So that's just an example on the hourly time frame on CAD CHF. So now we can get rid of that. And let's move over to USD JPY in the 15-minute time frame. Let's uncover that all-seeing eye once again, and you guys are going to see something very similar. So what we have are, again, the red lines are stop losses. The money symbols are retail money, because in order for a central bank or commercial bank or a hedge fund to make money, they have to take money from someone. That money is from the 95% of retail traders. I'm going to keep repeating it because what is repeated is remembered. So right here we have our beautiful illustration on the 15-minute time frame, and what is going on here is we have the market coming down. And we are seeing a downtrend. And again, remember that concept where if the market stops at a certain point, that's because there are buyers in these areas, right? We have a very strong floor because market rejected so well. Now we've got a double bottom or a W. Now retail traders are really licking their chops and they're really getting excited. So what happens is we have retail buyers in this area, and they need to put their stop loss somewhere because you don't want to blow your account on one trade. Stop losses are at this red area. What happens is in the matter of 30 minutes, central banks, institutions, they say F you, they send the market down, hitting stop losses, and then reverse the market. All right, ask yourself if this has ever happened to you. You've entered the market for whatever reason, whether it's a retail pattern or an indicator or something else, and you've got the directional bias right, but you got stopped out of the trade before the market moved in your direction. Has that ever happened before? If it has, that's probably because of these examples I'm showing you. So the reason I have Fibonacci here is because even though most retail buyers got stopped out here, maybe there were a few who were waiting for this push. Maybe it broke structure. Now we're going into an uptrend, and some retail buyers can see that. So they wait for a retracement, whether it's a break and retest scenario, or they're waiting for their fibs to line up so they can enter buys in these, because this is the most popular retail fib entry out there. So maybe market gets into here, they get a wick entry, they're stoked, they're putting their stop loss beneath the low, which can be under this low, or maybe, you know, under that low or this low or whatever, but we're just going to extend that out. And so what is happening is now we have buyer stop losses in this area within these two red things. So our money is sitting right there. Then what happens? Market comes up. The market stops because now we have sellers in the market. We have sellers in the market. When we have sellers, stop losses are above the highs, which is indicated by this red line. What happens? The market pushes up just with one little candlestick. One little wick is all it takes to take out 90% of retail stop losses, because they all trade the same way. So all their stop losses are in the same spot. All it takes is one little candle to wick out all the retail sellers. Central banks enter the market right here. This is where their sell is, where your stop loss is. And then what happens is market goes down. And where do you think it's heading to? Towards where the people were buying, right here, towards their stop losses in this area. Let me clean this up a little bit for you guys. So now that seller stop losses were hit, we are aiming for buyer stop losses. And what happens is market starts to come down, and maybe these Fibonacci break and retest trend traders are looking at this and they're like, oh my gosh, we're going to have another opportunity, right? So we're going to sell in this area, or we're going to buy in this area because it's hitting and it's respecting our fib, or it's breaking and retesting, or it's part of structure, whatever it may be. But retail traders are looking at this and they're following the trend. So we have more buyers in this area, right? We had buyers here. Now we've got buyers in here and here and here. And so what happens is we accumulate even more stop losses right in this area. And we've got even more money just sitting right there. And then what happens is, obviously, market shoots down past these stop losses, even lower. And what happens is this one little wick takes out all these past buyers, all their stop losses. And then what happens? Market reverses. Because now that retail buyers are out of the market, who's left? All the central banks, commercial banks, your brokers. They're the only ones buying this. And their lot sizes are in the hundreds of thousands, sometimes even the millions, versus your 10 lot size, or your 0.01s, or your 0.10s. Right? So these are the people you're trading against. And they are manipulating this market because they understand where your stop loss is, because 95% of retail traders lose. So that means 95% of retail traders trade the same way. So their stop losses are on the same spots. So one last example for you guys. Let's uncover what we're seeing here. Now this is GBP AUD on the daily time frame. And this one's going to be pretty simple. So I'm not going to go into this one too much because you've seen in the past two examples. But what we have is we have market trending up, right? It's in an uptrend. And for whatever reason, we may have buyers because this may be a fib retracement or a break and retest or whatever. So we've got buyers here. And so people are putting their stop losses beneath the low because that's what we've been told. So we hit a point where the market stops and reverses. So we definitely have a lot of sellers here. Otherwise, the market wouldn't fall. And then what happens is people probably see this as an opportunity to start selling again because it's an M, or it's a double top, or it's whatever retail trend they decide they want to use. And so what happens is we've got retail stop losses right at this line indicated by the money symbol. And what happens is, look right here. Look how interesting this is. A lot of people are probably putting in sells right in this area because this is a weekend. So this is a Friday. If you can see down below, it says the 3rd of May, 2019. The next candle is the 6th of May, which means right here there's a gap. And when there's a gap in the Forex markets, you cannot exit any trades. That means all your open trades are locked until the next day or until the market opens again. So everyone that's selling in here, everyone who has stop losses, who hasn't adjusted their stop losses or gotten out of the market, they're stuck. They can't exit their trades because the markets are closed. What happens when Monday opens? Well, the market's already up here. So before you even realize, your stop loss has been hit, and then the market reverses. And do you really think that this is all by coincidence, that this is just happening over and over and over again on accident? No. So now that we've hit seller stop losses, we need to hit the opposite side, which would be the buyers. Remember back here when people were swing trading or on the daily time frame, they haven't adjusted their stop losses because they're looking to swing trade this all the way to where price is right now, and they're thinking that this is just a very large retracement, which it is, but one big problem, their stop losses are where banks are aiming for. So what happens is we see a double bottom, right? We have one touch right here. Market comes back, it respects, and it bounces. So we've got even more buyers. It's accumulating even more stop losses. And then what happens, we have this one little wick. We have one day where this candle wicks all the retail buyers out, takes their stop losses. Banks are then getting into buys right here, and they're sending the market up. And just a little minor example on this, we have a double top right here, right? So even within these bigger examples, there are examples everywhere. So market comes up, it stops right here, it falls. Market does it again, that's a double top. Market does it a third time, and it falls. And all it takes is one little wick to take out all the retail traders and then reverse the market. So I know that's a little messy, but I'll get rid of that. So those are just 3 examples. I didn't want to go into too much detail because I've made a couple other videos going into more detail of how this is actually working, but I wanted to show you guys a few examples of why the markets move the way they do. And these markets don't move because of some crazy pitchfork idea, or they don't move because of some really interesting Fibonacci theory that you have, or they're not moving because of really strong support and resistance zones. No. These markets are moving based on liquidity. Where is all the money sitting? Because if you remember this one concept, this will help your trading. If you understand that in order for you to make money or a bank to make money, they need to take it from someone else, you need to ask yourself the question, where is the money sitting? Because when you understand where 96% of the money is sitting from retail traders, think like a bank, and then you can start entering your positions where 96% of retail traders are putting their stop losses. So I hope you guys enjoyed this video. If you're finding it helpful, we would love to see it in the comments below. Make sure to subscribe to stay up to date on these types of videos. If you guys are loving it, make sure to like and share, and we'll see you in next week's video.